Oh, there's no question. You're seeing, the numbers in all of vaults, except the LBMA, which is going the opposite direction. But yeah, you're seeing massive. I mean, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But seven-figure orders are no longer the exception at all. But yeah, you look at the COMEX numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it, SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain, look at like Saudi Arabia, who took this huge position in SLV. The one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving, and the numbers, the eligible numbers, are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote, very possibly, that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher, for sure.
Can you talk to us briefly about, and you did, but again, about the predicament that big money is having as they're trying to move out of the stock market, out of the real estate bubble, and they're going, uh-oh, where do I put my proceeds? What's the old bag of tricks? Why don't those work anymore? What are they looking at?
I mean, the old bag of tricks would be you put it into treasuries earning a fair rate of return and let the laws of compounding be your friend. Back in the day with 9% interest every 8 years, your principal would double. And if you had 9% interest and millions of dollars, that's fine. Double every 8 years. The law of 70 seconds, 9 into 72 is 8. Is that where we are right now, the inflation is far higher than the rate of return. And so a real negative rate of return makes bonds a no-starter. I mean, it's a no-go. And so then what? Do you put your money into an equity market where valuations are higher than at any time, even the 1929 crash of the stock market, anytime ever, at a period of time when you have the largest ever margin debt by the retail public, the largest ever exposure to options by the public, and the largest ever participation in the stock market by the public, as the insiders are literally moving the other direction. You put it into real estate when 30 years worth of suppressed interest rates have created great distortions. And where do you put it? These are very, very crazy times. So where do you put your money? Because of the suppression in interest rates and the distortion of asset prices for all of these years, asset prices, to invest into assets right now at all-time highs, you have to wonder, do they continue to go higher? I just happen to believe that there are very few places that offer the kind of appeal right now, not always, but right now that gold and silver do. And I think you are seeing sophisticated investors wake up to that. Again, who the hell is taking possession of billions of dollars worth of gold and silver every single month? Now, when I say possession can be held in your personal storage account unencumbered in a COMEX vault, sure, or it can be taken off the COMEX. Both are happening, but big money nonetheless. This is money that is not just big, it's sophisticated, it's well informed. I think that's kind of the key. But when you see this, not only the front running by the central banks, whoever's doing it here in the United States, when you see the absolute certainty that you're going to see a devalued dollar and lower interest rates, which will, what's that going to do to the back end of the market? Are there ramifications in the banks? All these things are connected. And when you take a step back, the only place that I would put my money where most of these things, if they play out negatively, I think gold is a benefactor, silver too. But I think you don't buy to become wealthy. You buy because it is wealth, and the biggest money in the world is showing you there are very few places safely to put your money other than gold and silver. So that would be my choice. Forget about the fact that I own a company that does it. I'm trying to be completely objective.
People always ask me, Andy, what the heck is going on in the metals markets? Why are we seeing all this big money suddenly pile into gold and silver? And the first thing I tell them is this: look at the vaults, look at COMEX, look at LBMA, look at the ETFs. You don't have to listen to my opinion, just look at the numbers. The biggest money in the world is quietly hoarding physical metal. That's not a conspiracy theory, that's data. Now what's interesting is the divergence. The COMEX vaults are bleeding, silver is flying out. The LBMA is a different animal. Their eligible numbers are up, but much of that is simply custodial shuffling. You've got Saudi Arabia buying huge positions in SLV, which frankly I hate because SLV is one of the most manipulated tools out there. Naked shorting, rehypothecation, it's all there. But here's the saving grace. When you're big enough, when you're talking billions, you can demand delivery. That's exactly what Kyle Bass did with the Texas Teachers Union when he put $1 billion into gold via GLD. He didn't leave it there. He took it out. He demanded bars. And that's the point I keep making. When you see nations, sovereign wealth funds, and billion-dollar institutions step into ETFs, it's not because they want exposure to the price. It's because they want a way to take delivery without shocking the market on the buy side. That's hoarding, plain and simple. But let's step back for a second and put this in plain English. Why is this happening? Why is the biggest money in the world turning its back on the old bag of tricks, stocks, bonds, real estate, and running into gold and silver? Because those tricks don't work anymore. Look, I grew up in an era where you could put your money in US treasuries, clip a 7, 8, 9% coupon, and sleep well at night. Compounding was your friend. The rule of 72 meant your money doubled every 8 or 9 years. That was safe. That was normal. That was boring. But boring was good. Now fast forward to today. Treasuries pay you 4% if you're lucky. Inflation is running 6, 7, 8% in the real world. Forget CPI. That's a manipulated joke. Go fill your grocery cart, pay your insurance premium, send your kid to college. Inflation is double digits in many categories. So you're earning 4% while losing 8%. That's not an investment. That's a slow-motion wealth destruction machine. What about stocks? Everybody's in love with the stock market. The S&P 500, the NASDAQ, the Magnificent Seven. People think this thing will never go down, but history tells a different story. Valuations today are higher than in 1929, higher than 2000, higher than 2008. Retail investors are more leveraged than ever, margin debt at record highs, options exposure at record highs, participation at record highs. And you know what the insiders are doing? Selling, running the other way. When the public is all in and the insiders are cashing out, that's not a bull market. That's a setup. And real estate? Please. 30 years of artificially suppressed interest rates created a massive distortion. Prices went parabolic. Now mortgage rates are back at 7%, 8%, and affordability is at its worst level in history. Add in property taxes, insurance costs, and stagnant wages. The real estate safe haven is a bubble. So where do you put your money? That's the question. If treasuries are toxic, if stocks are overvalued, if real estate is unaffordable, what's left? Gold and silver. That's why you're seeing seven-figure orders in the retail space, billion-dollar allocations from sovereign wealth funds, and record withdrawals from COMEX and LBMA. Let me put it another way. We are watching a vote of no confidence in paper. That's what a gold breakout to $3,600 tells you. That's what silver flirting with $50 tells you. It's not that metals are suddenly exciting, it's that everything else is suddenly terrifying. Now here's the math that really blows my mind. At $3,640 gold, divide by 70, the current gold to silver ratio, and you get $52 silver. At the historical average of 45 to 1, you get $91 silver. At the geologic ratio of 7 to 1, you get $520 silver. And if Goldman Sachs is right about $5,000 gold, those numbers get even crazier. At 70 to 1, you're talking $71 silver. At 45 to 1, $111. At 7 to 1, over $700. Now, am I saying silver is going to $700 tomorrow? Number. But is it out of the realm of possibility? Not at all, because this isn't about speculation. It's about math. It's about supply, demand, and trust. Think about supply. Annual silver mine production is about 1 billion ounces. That's it. At $50 an ounce, the entire annual market is $50 billion. Apple is worth $3 trillion. Do you see the mismatch? One company is worth 60 years of global silver production. Which is more essential? Another iPhone or the conductive metal that makes the iPhone possible?
No one really is talking about it, which is kind of crazy. And, look, I think it's most important to understand that this is not gold going up. It's mostly currencies everywhere depreciating against gold, not just the dollar, but all currencies. And I don't know, it's not only a normal bull market, which I see very clearly, but it's also a monetary system reset, which I see very clearly. And when you see an environment where foreign governments and central banks hold more gold than U.S. treasuries, it's a sign that they trust gold more than they do the dollar and our debt. This is a big deal. This is a monetary reset. This is a reshuffling of the deck. I think people need to understand that. It's crazy that this isn't all over the mainstream, that this isn't spoken about. It's shocking to me, and it just makes my disdain for the legacy media grow by the day. Our massive debt means that we will almost certainly rely on money printing to pay it back, which erodes the value of the dollar. Foreign holders of our treasuries and our dollars do not want inflated dollars, so they too are shifting into gold. And it's because of the credibility, the liquidity, the physical security. This is what has shifted gold's bull run from $1,700 to $3,500 an ounce in just the last 3 years. And then at the same time, you got momentum building with guys like Putin and Xi and Modi who are openly urging trade in local currencies, which again are laying the groundwork for a world less dependent on the dollar, done again. And that's, this is what it is. It's not so much gold, it's the dollar, it's everything. Gold is the barometer by which we measure everything else. And when you have a treasury that is projecting well north of 22 to 25 trillion in debt in the next several years, with our foreign creditors who have supported our lifestyle backing away, I don't know, isn't it always been the Fed that stepped in and with more money printing, risking inflation? I don't think this is panic. This is a sober reality. Confidence in the dollar is slipping, and gold and silver, with its long-term 5,000-year track record, speaking of 5,000, that's the number that we're getting out of Goldman Sachs if just 1% of the money that's in treasuries pulls out of treasuries. Bald Guy Money did an interesting one, and he said if 20% pulled out, he was getting $9,000 gold. And would me, and then they revalue it. The higher the price of gold goes only benefits this country on many levels, not only through the devaluing of the dollar, but also, of course, the ability to, if Judy Shelton is right, peg gold to the back end of the treasury. You know, this will probably, I doubt people would get this, maybe people watching your show, but if you bought, what do you think was the best performing asset if the day Nixon closed the gold window on August 15th, 1971. Well, obviously I'm asking the wrong crowd, but number one was gold, number two was the S&P 500, number three was the Dow Jones, number four was silver. And this is including reinvesting every dividend for compounding gains, which no one ever does. Investors never do that.
Let's start with COMEX. For years, COMEX was the tail that wagged the dog. A few big banks could naked short silver contracts, dump a pile of paper ounces on the market at 2 a.m. when liquidity was thin, and boom, silver would drop $2 in 5 minutes. It scared the living daylights out of retail traders, triggered stop losses, and reinforced the idea that silver was a widowmaker trade. But here's the Achilles heel. COMEX is fractional reserve. It runs on the assumption that very few people will actually stand for delivery. It's like a bank. If everyone showed up to withdraw cash at once, the bank collapses. Same thing with COMEX. Now here's what's changed. Over the last few years, the pattern has flipped. It used to be that on first notice day, you'd see X number of contracts standing for delivery, and by the end of the month, half of them would have disappeared as traders rolled out or cashed out. Not anymore. Now by the end of the month, there are more contracts standing than on day one. People are buying contracts and immediately demanding delivery. That's not trading, that's hoarding, that's a run on the vault. And remember, COMEX doesn't have infinite metal. At best, 5 to 10% of open interest can be delivered physically. The rest is just paper. If a big player, say a sovereign fund, a central bank, or a Saudi-size SLV position, demands delivery of more than what's available, you get a failure to deliver. And once that happens, the whole world realizes the emperor has no clothes. Think about the psychology of that. You've got a market worth billions, trillions in notional paper contracts, and suddenly one corner fails. A major bank says, "Sorry, we can't deliver." What happens? Everyone rushes to stand for delivery before the window closes. That's the stampede. That's the panic. I call it the shark smelling blood in the water moment. Because once the smell is out there, it's a feeding frenzy. And here's the kicker. Short squeezes don't end with higher prices. They end with bankruptcies. Because when you're short a commodity and you can't deliver, you don't just lose money. You lose everything. Your contracts go to zero. Your balance sheet implodes. That's what happened to Bear Stearns. That's what happened in nickel on the LME in 2022. Prices went vertical, the exchange panicked, and they literally canceled trades to save the shorts. But when you cancel trades, you destroy credibility. And credibility is the only thing keeping paper alive. So ask yourself, what happens when silver pulls a nickel 2.0? What happens when contracts go from $40 to $400 in a matter of weeks? And the exchange says, nope, sorry, we're not honoring that. Confidence breaks. The Western paper markets implode. And at that point, the only silver price that matters is the one you can pay in Shanghai, in Dubai, in Mumbai, where people actually deliver bars. Now let's talk about the geopolitics, BRICS, Shanghai Cooperation Organization. Whatever acronym you want to use. The reality is half the world is moving away from dollars. Why? Because the issuer of the world's reserve currency is bankrupt. Everyone knows it. They're just not allowed to say it out loud in Washington or Brussels. Saudi Arabia joining BRICS wasn't about symbolism. It was about oil for gold. It was about settlement outside of dollars. When India buys Russian oil with rupees or yuan, that's not a one-off. That's the new system being born in real time. And the glue that holds that system together isn't trust in fiat. It's gold, it's silver, it's platinum, it's the metals you can't print. Now think about this. India's silver imports up 431% year over year. China withdrawing 27,000 tons of gold from the Shanghai Gold Exchange since 2002. Russia sitting on 12,000 tons, much of it off balance sheet. Do you think they're doing this for fun? For jewelry? Number. They're preparing for the next monetary system, and that system will be backed, at least partially, by gold and silver. This is why I keep hammering the point. Silver isn't an investment. It's not something you trade. It's not Tesla stock. It's not Bitcoin. Silver is wealth. It's money. It's your lifeboat when the ship goes down. Now let me address the skeptics. People say, Andy, if silver is so critical, why is the price still $40? Why isn't it already $500? Great question. The answer is manipulation, but not in the cartoonish sense of men in smoke-filled rooms cackling over their Bloomberg terminals. It's structural. Western banks have had a vested interest in suppressing silver because it suppresses gold, and suppressing gold suppresses the signal of no confidence in fiat. If gold is $25,000 an ounce, if silver is $1,000, what does that say about the dollar? It says game over. And the U.S. Treasury can't afford that signal because they need to borrow $2 trillion every year. They need foreigners to buy that debt. And foreigners won't buy if the dollar looks like toilet paper compared to gold. So they smash the metals. They flood the market with paper. They sell contracts they don't have. They scare investors out. And it worked for 50 years. But here's the problem with manipulation. It only works as long as you can deliver the real thing when someone calls your bluff. Once you can't, it ends badly. Every manipulation in history ends in a blow-up. Every single one. That's where we are. The blow-up phase. Let me bring it back to something more relatable. The old advice during bad times was, go to cash. But what is cash? In 1930, cash meant gold-backed dollars. Today, cash is an IOU from a bankrupt government. That's not safety, that's risk. So what's the new advice? Go to real money. Go to gold and silver. Because when the reset comes, and it will, those holding physical will become the new banks. They'll have capital when everyone else is wiped out. I know that sounds dramatic, but let me paint the picture. Imagine a retail investor today selling silver because they need cash. They think they'll buy it back later, cheaper. Except later, there is no silver. COMEX fails. Retail shops are empty. Premiums explode. Suddenly, silver eagles are $200 if you can find them, then $500, then gone. That investor's off the bus. And once you're off, you don't get back on. Meanwhile, the sovereigns, the hedge funds, the billionaires, they're still stacking. They're still taking delivery. They're still front-running the collapse. And when the public finally wakes up, it'll be too late. That's how wealth transfers happen. Quietly at first, then all at once. I want to share something funny I saw online. Someone tweeted, if silver ever hits $500, I'm buying a Lambo. I had to laugh. Because if silver hits $500, you won't want a Lambo. You'll want farmland. You'll want a community. You'll want security. Because $500 silver isn't about getting rich. It's about a reset. It's about surviving the collapse of trust in fiat. And let me add this. The reset has already started. Bretton Woods in 1944 was a reset. Nixon closing the gold window in 1971 was a reset. What's happening now, the slow abandonment of the dollar, the hoarding of gold and silver, that's the next reset. It's not coming. It's here. The only question is, are you prepared? So to bring it all together, big money is hoarding metals through ETFs, COMEX, LBMA, and direct delivery. COMEX is seeing unprecedented standing for delivery, a signal of imminent stress. BRICS nations are preparing for a new monetary system backed by real assets. Western banks can't suppress metals forever because delivery constraints will blow up the system. The public is asleep, selling metal for cash while insiders accumulate. This is the setup of a lifetime. If you're watching this, I'm not here to scare you. I'm here to tell you the truth as I see it after 35 years in this business. The opportunity is still here, for now. Physical metal is still available. Premiums are still reasonable. But that won't last. When the dam breaks, the shelves will be empty, the contracts will be worthless, and the only question you'll ask yourself is, why didn't I act sooner? So my advice is simple. Don't overthink it. Don't try to time it. Don't wait for the perfect pullback. Just take action. Get some metal out of the system. Hold it in your hand. Because in the end, it's not about making money. It's about keeping wealth. It's about having something real when everything else burns down. And when your neighbor asks why you bought silver, just smile and say, because it's the one asset they can't print.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.